Wanted to do a real quick video just to really explain how stock market charts work. And stock charts, while they may look complicated and a little bit intimidating at first if you've not had much to do with them in the past, are actually quite simple to construct and to read and interpret once you understand what the components are all about. To better understand how stock market charts are constructed, let's perhaps build a chart using an analogy of some everyday product. Probably the quickest and easiest way to explain this would be to use something we're all familiar with, and that's petrol prices, putting petrol in your car. Because we know that petrol prices, just like stock market prices, fluctuate almost daily. For example, I filled my car up last week and I paid, I think it was about $1.38 per litre for the fuel. Now, I know that $1.38 is a little bit more expensive than what I'd previously paid the weeks before. Even though I haven't been charting it, I just know that $1.38, that's a little bit more than the average price. So if I were to chart the prices, it'd be very, very simple, and we're going to do it now. A chart really consists of two main components, and that is price and time. Okay, time is along the x-axis. When we look at a chart, we have a line going along the bottom. This is the x-axis. Okay, and then we have a line going up the side here, generally on the right-hand side. Can be on the left, and often it can be on both, but more often than not on stock charts we're looking at the right hand side, and this is the y-axis. Okay, and this is our price. Now let's just suppose again we're looking at our petrol prices, and suppose I am putting petrol in my car weekly, and let's say I do it on a Thursday, and we're going to track the petrol prices over the last 6 weeks. So we need 6 time points. 1, 2, 3, 4, 5, 6. Okay, we might call these Thursdays because I fuel the car up on a Thursday. So each of these is a Thursday. We'll just put a T here. Okay. We could obviously put little days in between: Friday, Saturday, Sunday, Monday, Tuesday. You get the idea. But we're looking at this chart at the moment, we're looking at Thursdays. Over on the y-axis, on the price line, we are looking at prices. Now I know that, and a price line obviously starts down the bottom at 0 up to the top, whatever the top price is. Just like a x-axis is our time. The older dates are back here, so if we're looking at a yearly chart of prices that started way back here, that could be back in 2008 or something, and then we're going ... through time. The nearer we are to the right-hand edge, the closer we are in time, and this is 2019. Okay, so older stuff to the left, the newer stuff to the right. The y-axis starts at 0 and goes up in price. Okay, so we're looking at our prices here. I know the highest price I've paid over the last 6 weeks was the other day when I paid $1.38 per litre for petrol. Okay, and then I think it was about $1.36 or so. We'll do it in those sorts of increments anyhow, just to make the thing a little bit tidier, a little bit easier to follow. $1.32, and we'll call this $1.30. Okay. Now, to plot the prices of what I've paid for fuel on this chart, I know that the most recent day that I fueled up the car on Thursday, I paid $1.38. So where the X and the Y lines intersect one with another, I'm going to put a little dot, because I know that that was how much I paid for petrol on that day. Okay, the week before, let's just say I paid $1.34, well, where the X and the Y intersect, which by intersect I mean obviously they've crossed each other. Okay, where the two intersect, that's where I'm going to put my little dot because that's where I bought the petrol on that day. I'll get rid of those lines to make it a bit tidier. Okay, let's just say on the week before that, I paid $1.30 way down here. And just suppose that the previous weeks were somewhere in between. And in actual fact, they could have been, instead of $1.32 or $4, they could have been $1.33. Even though it's not plotted on the chart, we can still work out where it is based on a bit of an in-between price. Okay, that is our chart. Now, in order to make this chart a little bit easier to read and understand, all we need to do, and I'm going to grab a different color for this, is we draw a line between each of the dots. Okay, and that's our chart. So visually, it's really easy for us to understand when we look at a chart like this exactly where we've bought our petrol cheap and where we've paid more than average. Just looking at a chart like this, I know that last week I've paid the most amount of money for petrol that I have within the last 6 weeks. And I know that about 3 weeks ago was the cheapest time for me to have bought petrol because it was down there at $1.30. It hadn't been at $1.30 in the previous 3 weeks, and it hasn't been there since. So simply looking at a chart like this, I can start to get a real good visual representation of petrol prices over the last 6 weeks. Okay. Now, just to add to this, there is another component that you would be interested in charting, and most charts will have, and certainly your stock charts are going to have, and that is quantity. Okay. So we've looked at time, we've looked at price, but we have not yet indicated quantity, and we're going to do that now. Okay. I'm just going to move this off the screen just to give us a little bit of extra room. So in order to track quantity, let's just draw another line along the bottom here, as well as one along here. And as you can imagine, these are going to line up with these days as well, because what we're tracking is on each of these days, how much petrol did we actually put in the car? Okay, we know what we paid for it. We know what day it was. What we don't know is how much petrol we actually put in the car. So we could put some little ticks along here with some corresponding numbers. And we could say that, gee, how much petrol does my car take? I think it's about 60 litres or so. Let's just put a 60 litre up here. So this will be litres. We'll go 50 here. 40, 30. Now, again, correspondingly with the intersection of the X and the Y axis, I am going to say that, well, gee, last week, because petrol prices were so high, there's no way I was filling my car up. I only put 40 litres in, not the whole 60. Okay. The week before that, I put 50 litres in because I thought the price wasn't too bad. And certainly when it was down low, I filled the car right up. In fact, at that price, because I could see there was a better than average price, maybe I went back and filled it up again. Let's just say on that week, I put around about 45 litres, and you get the idea. Okay, so this is just tracking volume or quantity. Now, we can join these lines together as well, just like we've done here, but generally with volume, we've just got a straight line going down to the baseline. Okay. All right. And that there is our chart. So now, if I was to look at this chart, I could easily see that when petrol prices were low, I put a lot of petrol in because I could buy it for $1.30, so I filled the car right up to 60 litres. When the petrol prices are high at $1.38, I'm going to put less petrol in, 40 litres, because it's so expensive. And so you can see here, we've got the full picture now. We've got time, we've got price, we've got volume or quantity. So I know that what days petrol prices are good or they're expensive, and how much petrol I'm putting in the car each time based on the price of the fuel. So I hope that makes sense, and we're going to now have a look at how we can use this in the stock market. So here's an actual stock market chart, and using the same analogy as I just did with the petrol, we're looking at a line chart here. This is a chart of Telstra, which is an Australian company. Telstra is, of course, the telecommunications provider for the telephone networks and that. Now, having a look at this chart here, again, we've got all the dips and all the movements in the price, and we can kind of see where prices have been high, where they've been low, and where they've fluctuated around, just like they did in the petrol price analogy. The difference here, of course, is rather than looking at 6 Thursdays, the information that I'm looking at here initially is up to date here of July, which is, of course, today, July of 2019, going back to around about the same time last year. So we're looking at a year's worth of data, but we're also looking at the dots would have been joined on a daily basis rather than every Thursday like we did. Now, I can change this, and rather than looking at daily prices, I can look at weekly prices, which of course bring me right back to 2014 or so. I can change it to look at monthly prices to go back even further, and so it goes. So straight away, without even knowing too much about stock market charts, what we can see is, well, we know that Telstra was around about $8 or $9 back in 2000s, 1998, so that's 99 2000. If we hover over here, it'll tell us the date was the 30th of the 11th, 1999. The price of Telstra was closed at $8.88, and it hasn't been back at that price ever since then. And in actual fact, it's fallen, right down to 2010, where it started climbing again, but it's only been as high as about $6.50. So we're not going to go too much into detail about that or why that matters to us as stock market traders. We're just looking at the basic components of what make up a chart and start making some intelligent trading decisions based on what we're looking at. Okay, the other thing, of course, is we're only looking at price and time, just like we did in our petrol price analogy. But we can now say, well, okay, I'm interested in the volume. So we go up here and we grab, there's a whole bunch of different indicators and that we can look at, which again may look confusing or daunting at first, but don't worry. We're going to go through these as the videos go on with additional videos. I'm going to drop the price onto the X timeline to say, okay, I want to also have a look at the volume. I want to have a look at the volume, and there it is there. Okay, but rather than looking at how many litres of petrol we put in the car each Thursday, what we're looking at here is how many shares changed hands any particular day. So I'll go back to the daily charts, and I want to know how many shares have traded each day. So if I hover my mouse over here, I can see that today, which is the 16th of July 2019, the value is 28,173,980 shares changed hands at this particular price, which is $3.74. I'll just change that. It's a little bit hard to see that. I won't show the last trade. Okay, you can see around $3.74 on the July the 16th. We can see that 28 million shares changed hands. But we can also see, just by looking at this, where the huge volume spikes were, because there were around 85 million shares changed hands on the 29th of January, as opposed to, a few days before where there were only 15 million. We can start to derive at conclusions and say, how come a stock like this that was previously trading about 15 million shares every day, 11, 16 or so, suddenly 85 million shares change hands, and it happens here. Let's just do a little analogy here. Happens here, 85 million shares change hands, and then all of a sudden, boom, up goes the share price. Interesting. And these are the sorts of things that we can start to derive as stock market traders. We're looking for footprints like this as telltale signs to say, okay, who's got enough money to buy 85 million of these shares that, by the way, had been coming down for a long time? All of a sudden the volume comes in and up goes the price. Interesting. Something's going on here. And again, this is a little bit out of the scope of this particular video, which is more of an introduction to how charts work, but just to give you an idea of what's coming up and what we're going to be looking at. Okay, we're going to move on now and let's have a look at it. There's a couple of different sorts of charts that we're also going to be interested in. This is our basic line chart, which we looked at in the petrol scenario, whereby we're simply, tracking our daily prices and drawing a line between them. But we can dig in a little bit deeper and get a lot more information when we start using what we call open, high, low, close charts and candlestick charts. Let's have a look at those. So this chart here, of course, is our line chart, and that's the most simple of charts that we can use. But we want a little bit more information, and this is where we jump across, and there's two main charts that we use as traders, and that is what they call the bar chart, which we'll bring up now, or even more utilized is the candlestick chart, which we'll have a look at in a second also. Okay, I'm just going to zoom in here a little bit because I want to show you the detail of the information in each one of these little lines or bars, as they're called. Okay, what you're starting to see here is instead of each day where we draw a dot and a dot and a dot like we did with the fuel and we join them together and it gives us, it gives us a great indication as to what's happened. We've actually got more information here in our bar chart because what each day represents is you can see there's a little tick to the left, there's a tick to the right, and there's a bar in between. Okay, this is what they call a OHLC, open, high, low, close chart, and it works like this. We want to know where did the stock open. So rather than just saying, okay, I bought petrol for $1.38, which is great, let's put a dot there. I want to know where did the stock price open this day. So let's just suppose that the stock opened at $12. We draw a little line and say, right, there's our opening price for the day. But also what happened during the course of the day. We want to know what did the price finish at, because the stock market opened and everybody was happy to pay $12 for the stock. But what's more interesting is at the end of the day, the price rallied up and went up and down and did whatever it had to do. It actually finished at $14. Okay, so that's important to us because it tells us that the stock price opened at 12, it went higher and closed at 14, so it's finished quite strong. Okay, but we also want to know another couple of factors is how low did the stock go throughout the course of the day and how high did the stock go throughout the course of the day. So let's suppose the stock went as high as $20 and went as low as $9. How would we be able to represent that? Well, it's very simple. All we do is we draw a line here from 9 and we draw one at 20 and we just draw a complete line between the two. Okay, and then we join these here and that's our open, high, low, close bar. So we know now that the stock opened at $12 because that's the tick to the left. We know that during the course of the day it fell down to $9. It went as high as $20 throughout the course of the day, but it finally settled and closed at $14. Open, high, low, close. I hope that makes sense. Let's have a little bit of a look here. So this is what this chart is showing us on Telstra. We know that today this stock, you can see, opened at $3.81, went as high as $3.82, it fell as low as $3.73.50, and it closed at $3.74. And that is represented here. Open, high, low, close. Day before, open, high, low, close. What you're going to see, of course, is on some days there are the low and the open are exactly the same, or perhaps where the open and the high are the same, and you're going to see days like this where the open and the high and the close are the same. Okay, so you're going to see T's like this, where of course it opened at the high of the day. That's as high as it ever went. It did go lower, but it came back up and closed at the same price as it opened at, or was as high as well. So there's all sorts of little patterns, I guess, that will show you. Here's one here where it opened here, went as high as here, but it closed on the low of the day. So you're never going to see, well, you're not never, you quite often you'll see days like this where it'll be an open, it'll be a high, it'll be a low, and it'll be a close, or it'll be an open, it'll be high, low, and then the close is lower than the open. But there will be days where it's like this, where it opens here, goes low, comes back up and closes at the same point as the open and the high. Or it might do this, where it opens here, goes high, goes low, comes back and closes exactly the same, which of course is like a cross. Or it'll open here, go high, and then come back and close at the low. So there's all sorts of things like that. And I guess that gives us a little bit of an insight into what's going on in the day as well. Because, clearly a day like this is a weaker day than a day like that, because what we're seeing is the price opens here, but the sellers are coming in and pushing the price down and closing it on the bottom, as opposed to perhaps days like this where it opens on its low and it doesn't go any lower. It just gets pushed up and up and up and up, and then closes not at the high, but fairly close to the high, and just before that there's a little bit of an upward run. Not before it, as that happens. So we can see strength and weakness. Here's a good one just before an upward run here. You can see here there's been a nice little uptrend in the price, and have a look at what happened before that. We can see that the price here opened right at the low of the day, or very close to it. The price has got pushed up and up and up, and it closed right on the high. And that is telling us, and also there was quite a bit of volume on that day, that's telling us that the buyers are in control. They're pushing the prices up and up and up, and in fact they were, even to at the close of the market, buyers were still trying to get in, and they were just paying top price. The market closed, and then of course the days following, the price just kept going up and up. So these are also very, very important little signals to us. Let's jump over now and have a look at probably the most popular of the charts, and that of course is the candlestick chart, which gives us even more information yet again. Now, a candlestick chart is really not that dissimilar to a bar chart, in the sense that we're also tracking the open, the high, the low, and the close, but they give us a little bit more information, in the sense that we go to candlesticks, we can actually change the color too of the up day and the down day. And generally most candlesticks are green on an up day, red on a down day. So we'll do the same here. Okay. So as you can see, very similar to a bar chart, in that we have the open, we have the high, we have the low and the close. Okay. The difference being green candles visually, straight away, if we zoom into a bit of information, we can see straight away the down days without having to really look too hard, because they're red and the green days are the up days. So what that means is the red candles, if we zoom in back in again, the red candles have obviously been a down day, which means the open is up here, the close is down here, as opposed to a green candle, which has been an up day. That would indicate that the price has closed higher than what it opened. So it's still the same as the bar, in the sense that we have the open here, we have the close here, we have the high here, and we have the low here. But rather than drawing the open, high, low, close like a bar, we basically have the open, the close, the high, and the low. But we basically draw a box around these guys here. Oh, not very straight. And then a wick, a candle wick. Okay, so that still indicates our open and our close. And because it's an open rather than a filled coloured red candle, we know that that's an up day. It opened lower than it closed. If we were to fill that in and make it red, obviously we know that it's a down day, which means it must have opened here and closed lower. The advantage of looking at candlestick charts is we can see patterns quicker and easier than we can with our bar charts, and certainly much more so than our previous line chart. And we're going to go into a lot more detail in other videos. This is not the place for it. But we can start to recognize patterns where charts have got a longer body and a shorter wick, or they've got a long wick and a shorter body. There's so much psychology that goes into these sorts of charts, and this is a really exciting topic which we'll cover again soon. But there's things like spinning tops and dojis and hanging man and all those sorts of things, which have got all these crazy names, but they all mean something, and we can start to derive some kind of pattern scanning within our trading system to say, every time we see a hanging man or a spinning top, we can kind of say, well, that's a turning point for us. Just to give you an example, and again, I'm not going to go into too much information about it here. We can see that perhaps down here, well, here's a classic. We've had a bit of a runoff on the downward trend, where we then had a spinning top where the high and the low are the same, and there's a short wick, and then there's a bit of a turn in the market, and up it comes. Again, it's out of the scope of this video, but just know that these things exist, and we'll be diving into them a lot deeper in upcoming videos, because honestly, there's some really awesome money-making opportunities and some great trading opportunities once you understand how these work. But this is a basic example of understanding stock market charts. So now, when you look at a chart, you're not daunted and thinking, what's all this information? It's really no different than our previous example with the fuel prices, where we've got quantity or volume down the bottom. Along our x-axis, we've got time, February, March, April, May, June, right through to July of today. And of course, we've got price. And because we're looking at candlestick charts, we know that a red candle has fallen in price, therefore it opened here, went as high as here, went as low as here, and closed here. Our green candles tell us that it's an up day, so even though that's got a tiny little wick down here, it opened, went lower, but it closed, and in this case, because there's no wick to the top, it closed on the high of the day. And once you start using these charts, this will become really, really easy to know and understand, and in actual fact, will become your new best friend. Okay, let's have a quick look at some basic indicators, just to give you an idea, because you've probably heard people talk about stock market charts, throwing in all these different indicators, stochastics, moving averages, rate of return, all these sorts of indicators, and you're thinking, what are these things? How do they work? And why would I use them? Now, again, it's not my intention to try and confuse you too much in this video. This is a basic video of how stock market charts work. I've tried to explain it as simply as I can, but just know that obviously there are a bunch of indicators that we can start to use, because charts are essentially a window into the health of a stock. If we're buying shares, we're essentially buying a small part of a company, and we want to know, how is that company trading? And is the price that we're paying for the stock expensive, or is it cheap? And the only way we can know that is by looking at a chart of prices, just like the petrol, to know, is the price expensive today compared to where it was 6 months ago? And in this case, yes, we know that if we'd have bought Telstra back in January of 2019, we'd have paid about $2.70. If we've held out this long and we're now buying the stock today in July, we're paying about $3.90, which is, $1.20 more than what we could have bought it for. Now, is that a good price? Well, we need more information before we can make a judgment on that, because either we're paying the top price before the price comes plummeting down, Or we're paying, yes, we are paying the top price, but there's a further move to go forward. Now, we can't actually see what happens tomorrow. It'd be nice if we could. But we can see what's happened historically. And we can make some educated choices based on that. The other important factor, of course, is that stock market charts give us a visual idea of whether the trade has been supported or not, meaning how many other people are buying this stock on any given day. And is there more volume being traded today than, historically over a period of time? In other words, can we draw a bit of an upward trend on the volume and say, well, on average, the volume's been increasing as the price been going up. So we think more and more buyers are coming into the market, which means it could be supported. Again, a little bit out of the scope of this particular video, but you get the idea. Now, we've looked at the components of a chart, of course, being time, being value or price, and quantity or volume. The other thing that we can start to plot on a chart are indicators, and there's really a few different types of indicators. There are trend following indicators, which really indicate to us which direction the market's going, if it's coming down or if it's going up. There are what's referred to as oscillating indicators, which kind of tell us if the market is overbought or oversold, which can also indicate a change of direction is coming because there's just been too much volume at high prices, and of course there's going to be a change happening shortly. There are what we refer to as accumulation and distribution indicators, which is really our way of telling when large amounts of money are changing hands throughout the market, when we see large volume where buyers are entering into the market, and then those large amounts of volume coming back out of the market as shares are being bought and sold. We use accumulation distribution type of indicators. There's what we refer to as convergence and divergence indicators, which again, a little bit out of the scope of this video, but they tell us when a potential change is likely to happen. And then there's also what we refer to as compression and expansion indicators. Okay, and what they are is basically like Bollinger Bands and indicators where prices get closed and compressed into a range that we know can't be sustained for too much longer, and we know again a potential change has to happen where the price will expand again. So we use certain indicators to show us where these compression and expansion points are happening. And indicators can really be broken up into a couple of different categories, either leading indicators or lagging indicators. Lagging indicators, as the name suggests, mean that the indicator follows the price. It's a lagging, it's behind the price, such as a moving average or something whereby it's telling us what has happened in the past. It's a lagging indicator, as opposed to a leading indicator, which is really an indication of showing us what is potentially going to happen in the future. Now, of course, unfortunately, no stock market charting software program is a crystal ball. It's not a genie in a bottle, and it certainly isn't a clairvoyant and can't predict the future. So even though we have leading indicators which can tell us of potential changes, there's no guarantee that it's going to tell us what the stock prices are going to be tomorrow. But we as stock market traders, of course, that is our objective, that's our goal. We're constantly looking for ways to see what is going to happen tomorrow. We're always looking at the right-hand edge of any screen of stock market chart and saying, okay, I know what happened today, I know what happened yesterday, and I know what happened the weeks leading up to today. I can even show you what happened way back in the 1980s or the 1940s or 50s. But what I don't know is, what's today? It's the 16th of July. What I don't know yet is what happens on the 17th of July. And if we were able to do that, well, then we wouldn't be traders and investors, which would just be taking a sure bet and putting all our money into the market. If I knew unequivocally that tomorrow this price is going to be $4.20, well, I'd just, sell the house, sell the cars, put all the money I've got and can get access to on the market because I know that I'm going to make a huge return on my investment. Unfortunately, we don't know that. So we as traders and technical analysts are constantly looking at charts and working out ways to try and determine at best possible where the price is going to be. And the only information we've got to go on is where the price has been. So we can start to derive some kind of educated decision based on, okay, this price has been in an upward trend for some period of time, where it's kind of been going since, the start of the year. It's been going in this nice steady upward trend. There's been a couple of times where it may have broken through. Our gut feel is that it's going to continue along this line. That's our best educated decision we can make about a chart like this. Or it could fall through this tomorrow, and then at that point we'll say, okay, well, this chart had been going up in a nice upward trend for a period of time. It broke through that trend. It's now falling, so I think it will continue falling. And really, that's all we're doing. And as you watch more of my videos, you'll start to see some of the trades that I make and some of the choices that I make in my trading decisions based purely on my technical analysis ability to be able to determine what I think is going to happen based on what's already happened. And that's all we're doing as technical analysts. All right, so let's just have a look at a couple of quick indicators. We're not going to spend time going through each and every one of them, obviously, because, in programs such as Metastock, there's literally hundreds and hundreds of them. Some of the most common ones, perhaps, are moving average. So if we're looking at prices like this, we know that it's currently $3.80. It has been down and around about the $2.70 mark. If we were to average that, we'd say, the average price is probably about $3 or thereabouts. But we can actually put a moving average on there. And we just drop it straight on top of the price there. We can give it a color. Let's make it, we'll leave it red, and we'll say okay. All right. Now, a moving average, as the name suggests, is moving, which means that it is going to follow as the prices change. This is and we'll look at the timeline here. We'll look at the parameters. This is a 9-day exponential moving average based on the closing price. Whoa! I don't want to scare you with all these, all these numbers and everything. And, you may already know all this. If you don't, that's fine too. Don't get hung up on this. Don't get too confused about this. There's three main indicators that we use with the moving average. There's simple, weighted, and exponential. And of course, there's a couple others, but we mainly use a simple or exponential. Let's just go on to a simple. So what that is basically saying is, if we look at this average price over the last 9 days, this is what this price has been. Now, remember when we did the petrol analogy, we drew a really basic line chart. We just drew a dot, 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 and connected the dots. That's our line chart. This is essentially all this is, guys. It is if we, on this day, said, what is the average price over the last 9 days? The average closing price, if you look at that, it is a moving average, and in brackets it's got close, 9, simple. This is telling us this is a simple moving average based on the closing price over the last 9 days. Okay? So what that is telling us is that dot on this day, based on the last 9 days, the price was here. And as you can see, as the price comes up, so too does the moving average. And as the price starts to, taper off a bit here, starts to go sideways, so too does the moving average. Now, just quickly, if we were to change the days on this, instead of 9, and we said, let's make this up in the 20s or so, or let's go with, whoa, that's fast. Well, let's do it, 60 days. So you think 60 days, that's a couple of months. And we can apply that, and we can say, where has the price been on average over the last couple of months? And again, the longer the time frame, the further away the line is going to be from the actual price today, purely because it is giving us the average of the last couple of months. Okay. Now, as you can see, this takes all of the noise out of the market. What I mean by that is, if we're looking at a chart like this, it's it's very jittery. There's a lot of noise going on because there is so much price movement between days. If we were to turn all that off and just look at the moving average, it gives us more of a straighter line. It's a smooth. It makes the market a lot smoother. So we can sort of say, well, the price of the market's been up around here. The good thing about this is it shows us where the market is in comparison to where it's been. It kind of gives us a bit of a moving trend line. Now, what a lot of traders and technical analysts will do is they'll actually use 2 or more moving averages together, where they'll say, okay, I've got a 60-day moving average. What I might do is I might put a 200-day moving average on here as well. I'll make this one a different color. Let's make that a bit of a grey colour, a bit easier to see. Okay. And what they're basically doing is they'll use this as part of their trading system, where they'll say, okay, this is a 200-day moving average, which is a much longer period of time, obviously. This is a 60-day moving average, shorter space of time. And then they might say, whenever the shorter price crosses over through the longer price, I'm going to buy here. So in this case here, the 2 have crossed over here. They would use that as a buy signal, particularly with all this volume leading up. They would say, all right, the price has been down because it's way below the 200-day moving average. But there's all of a sudden, there's a bit of a situation where the price have compressed and come a lot closer. There's been a lot of volume, and we can see now that the shorter term moving average, the red one, is starting to go up, and it's above the longer term 200-day moving average, and the price is above here as well, because you can see it crossed over here as well, but the price was still below the 60-day moving average. You can see where they've both crossed. That's their go signal, and they're saying, well, look, the price is above the 200-day moving average, the price is above the 60-day moving average, the 2 have crossed, I'm getting in. So they're getting in here at about $3.10 or 20 or so, and they're still holding this stock today at $3.80. And again, I get excited when I talk about this sort of stuff, as you may have picked up, and I don't want to confuse you with this stuff because it's out of the scope of this video, which is entitled, Stock Market Charts Explained, and I hope I'm doing a good job in explaining it without confusing you or making it daunting or, complicated, because that's not the intention. The intention is to just give you a bit of a basic idea of how stock market charts work, and how using a few little indicators, a few tools, we can start to derive some of our trading decisions based from that. Of course, the other really important thing that your stock market charting software will have, or needs to have, is the ability to draw things on the charts. And in particular, the most common thing you want to be able to draw are your trend lines. You want to be able to draw support and resistance lines, where you can say, okay, down here, the stock had been supported, meaning it hadn't been lower than here, and then it hits resistance. Once it hits resistance, it breaks through. Look, there's so many different things which you are going to learn as we progress, and it's exciting. But for now, just understand that these are the sorts of things that you will need to have on your charting package. There's so many different drawing tools on here. You can start to draw your triangles and where you're going to get in and out. We don't need to go into what all these drawing tools do, other than they're available and you're going to want to have them and you're going to use them. If you've enjoyed the video, please like it. Please remember to subscribe, and we've got a few more of these coming up shortly. So I look forward to seeing you in the next video, and if you've got any questions or comments, leave them in the comments field below and I'll endeavour to answer them for you.